Hey guys, Brennan here. Just thought I'd talk about the Strait of Hormuz again, because of course, it's the biggest news story in the world right now. Um, I'm going to talk more about the financial ramifications of the Strait of Hormuz being effectively closed. So, as we know with energy, oil and gas, it's in everything. It's the basic input for the global economy. The more energy you have, the more economic growth you have. No matter what your opinions are and on oil and gas and how much orange paint you want to throw at paintings, that's a joke. Look it up. It's needed. The reason why oil and gas is one of the main forms of energy worldwide is because of how cheap it is to acquire. Like there's a whole lot of crude oil and a whole lot of natural gas in the ground, as opposed to say lithium, what they would use for EVs. So we're going to see way less spending in the economy because oil and gas are inelastic. You kind of have to pay for it. And so that will crush businesses if this continues, which it most likely will. And so we'll probably see lots of defaults in the future as businesses and people just can't make their payments because energy prices are so high. And overall spending in the economy will decrease, and these prices will probably remain high for quite a long time, as 30 to 40% of the infrastructure, according to France's finance minister, has been destroyed or damaged. And so in order to bring these things back online from shutdown states, it'll take months, if not years, to repair some of these facilities. Like Qatar's gas field, for example. It's the largest natural gas field in all the world, and it's going to take about 3 to 5 years to fix. And that's going to impact the world's nitrogen fertilizers immensely. And so even if the Strait of Hormuz opens up tomorrow, we're going to have these refining capabilities down for a while, and at a vital point, especially when it comes to nitrogen-based fertilizers. And so that's not even including the 11 million barrels of oil that the Strait of Hormuz provides to the world daily being not delivered to the rest of the world. And so the world uses about 105 million barrels of oil per day. And so that's about 10% offline right there. And that's not even including the United States having their refinery issues and Russia having their refinery and oil port issues as well, which I believe comes out to about 18 million of barrels of oil per day being taken offline. And so we're seeing oil around $105 per barrel, when really it should be trading for 130, maybe 150 right now, maybe even higher to 200. And this is going to impact financial markets a lot. Like this could be the start of the crash that has been predicted by so many financial talking heads and YouTubers, hell, me. This is likely to create a financial crisis. And it will probably start with the bond market. And so in order to pay for oil, you need US dollars. And these foreign central banks and entities, investors, hedge funds, you name it, they all will likely hold US assets, like US treasuries, US mortgage-backed securities, US stocks. And in order to acquire those dollars, they need to sell those on the open market. And so U.S. Treasuries are the most important government bond there is. And if they have to be sold onto the open market, well, that's going to bring down the price of these bonds and increase the yields. And bonds determine interest rates for the global economy. And so if you have yields rising, you're going to have higher interest rates. And then it will probably create a doom loop in bond selling. And so we'll see higher interest rates. People will be financially choked, for lack of a better word here. And debts will be harder to service. And if the Federal Reserve does not step in to buy government bonds and manipulate interest rates and prevent them from skyrocketing out of control, we're going to see what's referred to as the Great Taking. And so the Great Taking, what I believe, it's a book that was written by David Rogers Webb. He was a hedge fund manager for many years, and he was able to find out that most of the securities traded around the world, they're not owned by the people that think they do own them. Because when you have securities through a financial intermediary, you don't have security ownership. What you do have is a security entitlement. And all these securities, they're pooled at central clearing parties, and they are swapped back and forth with financial entities to make their financial obligations happen on a daily basis, to keep the financial markets liquid and transacting with each other. And so his claims are the financial legal framework is in place to take these financial instruments as collateral in the event of financial markets breaking down. And this is very likely to happen if energy is hard to acquire. And it could cause the bond markets start to melt down. Because, well, you can print a bunch of money, but you can't print oil, and you can't print energy. You can't print molecules. So we're already starting to see it with the UK right now. Their bond market is effectively melting down, or melting up with their yields, as I believe their 10-year went up 1% in a month, and that's bad, because bond rates are not supposed to be like the stock market where they shoot up and down drastically. They're supposed to be moving in small increments because they're supposed to be the safer trade. And these markets may start to fall apart. Like, for example, the derivatives market. The derivatives market is essentially a giant market where bets are placed on bets, and then those bets are placed on further bets, and bets are placed on those bets, and so on and so forth. And derivatives are not real things, but they are legally made to take real things if parties do not make up on their promises. And lots of times collateral is involved. And that's the financial markets for you. It's usually liquidity chasing collateral, or collateral being placed and put on the line in place for liquidity. And so the 2008 financial crisis was a scenario where there was really bad collateral chasing not enough liquidity. And so we saw markets start to break down. And then we had the 2009 repo crisis, which repo just means repurchase agreement, where there was too much collateral in the system and not enough liquidity. And so in this scenario, if the bond market starts to have its issues, this collateral will be sold off for liquidity, and because the collateral enters the market, prices will go down, yields will go up, and then problems start to arise. And with David Rogers Webb, what he claims is that if the derivatives market starts to break down, that's when we'll see a giant game of musical chairs start to happen, where there's a certain amount of chairs and a whole lot of participants. And when that music stops, that's when a lot of participants will be left without assets in the end, because secured creditors are ones that put up collateral for a trade or a bet, and they will be made whole because they are the protected class in the event of a full-on global market breakdown. And so that's why I talk so much about having things physically, having, like, if you're going to enter into a trade and have a stock, make sure you have the security and not a security entitlement, like a stock certificate, for example. So that way you take your stocks out of the pool that is constantly being put up for trade back and forth with these financial institutions. Of course, that's not financial advice. That's just me talking out loud. But it's, the thing is, like with the derivatives market, on the low end, it could be $600 trillion. On the high end, it could be $4 quadrillion. The estimates are kind of all over the place, but it doesn't matter really what the full value is of this derivative market, whether it's on balance sheet or off balance sheet. It's still much larger than all the assets that are out there. And also it's much larger than global GDP per year. And that's what makes derivatives weapons of weapons of financial mass destruction, is what Warren Buffett calls them. And it's true, because if the market starts to experience problems, like with the bond market, because the bond market, as the years go by, bonds become less and less interesting for financial entities, because the yields just keep dropping, and inflation in lots of cases in the global economy exceeds the yields on these bonds. So why buy bonds when you can buy real things? And that's what terrifies me. That's what keeps me up at night. Is that people that think they have ownership in the things that they were promised that they do have ownership in, don't have ownership, because they don't hold securities anymore. They hold security entitlements. And so when I invest in these markets, I make sure that I have securities, that I hold them, that I just stay out of that mess, because where things are going, we could see a financial reset where the system completely changes, and it'll have to, because the system is broken, because problems are papered over, and we're starting to see the over-financialization of the global economy start to affect the actual economy. And it's affecting our societies in ways that are unintended and also intended. Anyways, I don't know how to end this video other than thank you for watching and sticking to the end. Like this video so that way it can send the video out into the algorithm for more people to watch. Comment down below what you think, and please subscribe to the channel, and I'll see you in the next one.